Good afternoon, everyone. Thank you for joining us today for our webcast. My name is Ed Coyne. I'm Executive Vice President and Head of National Sales for Sprott Asset Management. Today on the webcast, we're going to be talking about cryptocurrencies and looking at gold and Bitcoin. Is it new gold or fool's gold? With me today is our Senior Portfolio Manager, Reik. Trey has spent the last 2 decades on comprehensive analysis of publicly traded gold mining companies, developing significant perspective on the intrinsic values under a wide range of market conditions. Additionally, Trey is a renowned commentator on gold markets and monetary policy, including policies and actions of global central banks, global conditions on money and credit, and factors affecting supply and demand conditions for gold bullion. For those that aren't familiar with Sprott, I'll give you a brief overview, and then we'll go into the presentation. Sprott is a global asset manager providing investors with access to highly differentiated precious metals and real asset investment strategies, backed by 3 decades of experience. We manage more than $7 billion in precious metals and real assets and offer best-in-class solutions. We have 3 physical metal trusts. The first trust is the Physical Gold Trust, which trades on the New York Stock Exchange under the ticker symbol PHYS. We also offer a Silver Trust with the ticker PSLV, and a Platinum Palladium Trust with the ticker SPPP. In addition, we offer 2 factor-based ETFs focusing on junior and senior mining precious metals equities. Our senior mining ETF has a ticker symbol SGDM, and our junior mining ETF has a ticker symbol SGDJ. These are 2 factor-based ETFs, again, focusing on the precious metals equity space. In addition, we offer public and private long-short equities, lending, and credit, again, all focused on the precious metals area. In addition, we recently announced the acquisition of the Central Fund of Canada, which will add a 4th physical solution that will focus on both gold and silver. Now, if we could move into the presentation itself and talk a bit about cryptocurrencies and about the notion that is this new gold or fool's gold? Now, there's 3 topics we want to really focus on today. And it's really the 3 views of gold and cryptocurrencies, or more specifically Bitcoin, as long-term investments or speculative assets, view both in the terms of money, and lastly, dive into their store of value. And I think that's going to be where we spend the bulk of our time in today's presentation, is really talking about it from an investment standpoint. But before we dive into our first topic, Trey, can you spend a few minutes talking about what's happened in the year of cryptocurrencies to date?
Sure, and thanks for having me today, Ed. So I think that one of the highlights from anybody's point of view of 2017 financial markets has certainly been the explosion of interest in cryptocurrencies. Bitcoin has spent most of the year consolidating its position as the dominant crypto, has still about a 50% market share, but the success of Bitcoin in terms of its price appreciation, et cetera, has certainly spawned, a legion of new competitors. Last check, and it changes daily, there are now 1,174, according to one source, cryptocurrencies currently trading or in some process of development. And the market for Bitcoin, which had been sort of flat for a year or so before this year, around 16 billion, has exploded 600% up to about 94 billion. And the total market for cryptos, according to CoinMarketCap.com, is up to about 175 billion, having started the year around 18 billion. So that's about a 900% increase. So there's no question that at least in traders and speculators' portfolios around the world, cryptocurrencies have been a huge part of 2017.
So clearly it's been an active year. And I think that really leads us to why we're doing this today, right? Because everyone's talking about gold, everyone's talking about Bitcoin, and more recently everyone's talking about Bitcoin replacing gold. So we thought we would tackle a couple of these notions in our webinar today. The first one, and I think this is an interesting place to start, is looking at both gold and Bitcoin as long-term investments or speculative assets. And Trey, let's start with gold. Is gold a long-term investment in your mind?
Absolutely. Absolutely.
And how so? What have we seen over the last the decade or so from a return pattern standpoint in gold?
Well, flipping the question around in terms of whether Bitcoin and gold qualify as speculative assets, I think my way of terming this would be, if there's any category that gold can't compete with Bitcoin, it's in the speculative asset category, because the price performance of Bitcoin has been, nothing short of spectacular. On page 6 in our presentation, we have a graph of the gold price really stretching about 4 years. And the bottom line is that for most of 2017, certainly 10 months or so through 8 months through September, the trading range for gold was really about $100, between $1,200 and $1,300, which is 8.5% measured from the bottom. And if we even go back 4 years to when gold in 2013 was $1,400, the low in that 4-year period was $1,050 in late 2015. So that's about a $350 range, which over a 4-year period measured from the bottom again is about a 30% trading range. If we look at Bitcoin, by comparison, just this year the Bitcoin price has increased from 1,000 to just under 6,000 in recent days. So I think that Bitcoin is a lot of things to a lot of different people, but there's no question that it's become a very, very popular asset to trade in speculative and trading circles.
Well, that's, I think, a very good point, because speculation is certainly rampant right now in the Bitcoin space. And, gold, as you've talked about and we've read, time and time again, has centuries of history behind it, which I think, is a nice segue into the second point that we want to really address today, which is from a monetary standpoint. You've heard for centuries that people view gold as money, but what about Bitcoin? That seems to be a hot topic right now. Will it become a currency? Will it displace currencies? Is gold money? And then also let's look at Bitcoin. Is Bitcoin money?
Sure. So on the gold side of the equation, first, it is interesting that for billions of people around the globe, for a very long period of time, gold has represented a preferred medium of exchange and store of value. That's pretty much unquestioned. In fact, there are only a few areas in the world where gold is really not perceived as money or a money equivalent, and those are the United States and certain Western countries. Sovereign gold coins are freely exchangeable into local currencies in almost every reach of the globe, and central banks have clearly been accumulating their allocations to gold as a preferred monetary reserve over the last several years. So in that sense, central banks certainly view gold as money or a monetary reserve. There are some indications that gold is even being used as a medium of exchange in certain areas of the world that are a little bit tired of the hegemonic status of the US dollar. Most recently, China launched a crude oil futures contract denominated in Chinese yuan and fully convertible into gold on the Shanghai and Hong Kong exchanges. These are all small steps at the margin, but gold is certainly perceived as money in those ways. Bitcoin's reputation as money or near money is slightly different. There is certainly a group of folks who favor the use of Bitcoin in commerce. I have read 270,000 locations around the world that accept Bitcoin for payment. Unfortunately, only 3 of the top 500 largest internet retailers are in that group. And in fact, that number is down from 5 this past year. We'll get into the reason, why that is the case in a minute. But the bottom line is that the blockchain is pretty clogged. It takes longer than I think most people recognize to record transactions on the blockchain, and a fairly high percentage of the transactions, roughly 20%, fail or are never recorded. So it doesn't make a great currency for an Amazon to be selling you a shovel if they're not sure for a day or two whether the trade's going to clear and whether it'll be recorded. The average confirmation time for a Bitcoin transaction in June of this year, believe it or not, was 2,500 minutes, which is about a day and 3/4. So Bitcoin's not quite money, gold's not quite money, so I think we probably have about a tie there.
So Trey, you talked about 20% of Bitcoin transactions, or the majority of small-scale payments, fail to be recorded on the blockchain at all. That actually brings me to the next point, or the next slide, which is talking about Bitcoin versus credit cards in general. Visa, MasterCard, American Express. You've heard a few comments made that Bitcoin, or really the use of blockchain technology with cryptocurrencies, is going to slowly put credit card companies out of business. Can you talk about that scale for a little bit, and what that really means, and what people are making reference to when they talk about Bitcoin versus credit card companies in general?
Sure. So in the interest of full disclosure, the blockchain offers enormous promise in complicated transactions, like, for example, purchase of mutual fund shares, because when there's lots of different interested parties, and like in the case of mutual funds, you'd have a custodian and an accountant and a processor and a legal aspect. And so the blockchain offers enormous, I think, potential in areas like that. In very simple transactions, we keep mentioning buying a shovel from Amazon, the blockchain imposes some fairly onerous power requirements, et cetera, to record those transactions. And as an example, the Bitcoin block, includes roughly 2,000 transactions at the maximum, about every 3 seconds. Visa, on the other hand, in 2016, processed 82 billion transactions, or about 2,600 per second. And in terms of the energy required in this sort of cumbersome blockchain computer assignment, the energy that all of the Visa data centers in the country used last year equated to the power to run about 50,000 U.S. households for a year, whereas the power required for the far fewer number of transactions being recorded on Bitcoin's blockchain required enough power that was the equivalent of, say, 1.6 million U.S. homes for a year. So to boil this all down, Bitcoin as a network uses about 33 times as much energy as Visa as a network. But when you look at the number of transactions that Visa is actually processing with that power, a Bitcoin transaction requires 28,500 times as much energy as an individual Visa transaction. So it's not that the blockchain isn't interesting and has very interesting applications, but for simple transactions like buying things from Amazon, et cetera, I'm not sure I see a lot of promise there unless there are real breakthroughs in the efficiency of recording those transactions on the blockchain.
Wow. So at least in the short term here, in the coming months or even coming years, I'm not sure you're going to see a company like Visa necessarily go by the wayside on the heels of Bitcoin. How about shifting gears now to what I think is really the most important aspect of Bitcoin versus gold, or gold versus Bitcoin, is from an investment standpoint, or more specifically, as a store of value. Is gold a store of value? Let's talk about that a bit. And then let's go into Bitcoin as a store of value, and how should investors really be thinking about this new asset versus how they should be looking at gold as a long-standing asset.
Mm-hmm. So I think this is really the key category in which to establish similarities and differences between Bitcoin. On the similarity side, I think while it's always difficult to generalize about why anyone buys anything, especially gold or Bitcoin, I think it is fair to say that at least some portion of Bitcoin and gold buyers are motivated by similar concerns, namely the financially repressive policies of global central banks. And I think this concern really hit sort of a new peak with the advent of negative interest rates around the globe. People are a bit freaked out, frankly, by negative interest rates and what that means for their savings denominated in various fiat currencies around the world. So I think it's fair to say that one of the attractions of Bitcoin and gold to those folks is that there is a theoretically limited supply of both Bitcoin and gold versus the unlimited supply of fiat currencies under the direction of our global monetary stewards. So there is a phrase that Bitcoin is limited in quantity by the laws of math, and gold is limited in supply by the laws of nature. So the limited supply, I think, is appealing to most people attracted to both. Both Bitcoin and gold are a way to store or invest capital slightly outside the traditional financial system. And I think the popularity of Bitcoin and gold being sort of beyond the reach of central bankers, et cetera, is interesting. And then, as we discussed, there is this fringe role as money, which both Bitcoin and gold are developing.
And as it relates to, we've talked about obviously the similarities, right? And I think a lot of people can agree that Bitcoin and gold do have some similarities, and I think that's what's making Bitcoin popular in the short term at least. But what I want to really do, and I think this is where the listeners today are going to get the most out of this presentation, is really let's dive into the differences. You know, what makes Bitcoin different from gold, and what makes gold different from Bitcoin?
Mm-hmm. So the way I would organize this discussion is in the topics that are listed on slide 14, which is Bitcoin is really still in its early infancy. There is this immutable nature to what should be seen as a store of value. There's the volatility consideration. There are considerations of safety and trust. And then finally, the consideration of scale in terms of whether there is really the ability as a AAA type resting place for large amounts of investment capital.
Well, let's dive right into it then. Let's talk about the early stages of Bitcoin versus gold. I mean, everyone obviously knows that gold's been around for thousands of years, but let's really dive into that. What does that mean? Why is it so important that Bitcoin's relatively new? And what should an investor be concerned with or think about when they're looking to allocate to gold or Bitcoin?
Mm-hmm. I think one of the ways to look at this is the irony of Marc Andreessen's very vocal support of the cryptocurrency market. His firm, Andreessen Horowitz, has invested in tens and tens and tens of cryptocurrency competitors, and I've heard him talk about this on various occasions, and it's just always hits me as ironic that Marc Andreessen is a big fan and supporter of Bitcoin because he was also a founder and a director and a promoter of Netscape. And so the comparison is that, you know, while Netscape was once the undisputed market-leading browser in an emerging technology called the internet, very similarly, Bitcoin is the emerging undisputed leader for the cryptocurrency application of this emerging technology called the blockchain. So, you know, I don't mean to understate Bitcoin's advantage. They are certainly far out in front in terms of adoption and size, and that has led to a much more palatable volatility quotient on the Bitcoin side of the ledger than most of the other cryptos. But the bottom line is there are legions of scientists, investors, and entrepreneurs who spend an awful lot of time every day addressing Bitcoin's perceived shortcomings in terms of the blockchain, et cetera. And there's a lot of firepower out there to come up with a better mousetrap. And just as, with browsers or cassette tapes or all these other different examples, Bitcoin may be the ultimate winner, but Bitcoin may not be the ultimate winner. And I think it's really far too early for anyone to judge prospects of Bitcoin's long-term success, much less compare Bitcoin to gold as a enduring store of value.
And I think that goes back to what we were talking about earlier about long-term investment or speculative trade, right? As things are unwinding here, we're sort of to be determined still on what Bitcoin is going to truly look like. Well, as we continue to dive deeper into the differences, can you really go into gold and what gold really means in a portfolio as you talk about the newness of Bitcoin, right? Talk about the establishment of gold and why it's so important and why people do consistently use it in a portfolio.
Sure. And before I do this, for all of the Bitcoin enthusiasts who are listening to us today, I really do have to make one announcement, and that is that I don't think anybody associated with gold or any other store of value does not wish that they don't own $1,000 worth of Bitcoin from July of 2010, because $1,000 worth of Bitcoin from July 2010, I did the math before we came in, would be worth about $116 million today, and I could certainly use the $116 million as everybody could. So don't get me wrong, Bitcoin has been a true phenomenon and has made an awful lot of money for people and has a huge role in that speculative category. What we're talking here about, though, is this store of value. If you're a family office in Denver with $100 million, are you going to put $20 million in Bitcoin, or does it make sense to find a resting place outside the financial system on the gold side of the ledger? In my experience, anecdotally and otherwise, I have yet to encounter a tremendous amount of enthusiasm from stewards of very, very large amounts of wealth on the Bitcoin side of the proposition. So in terms of as a store of value, the immutability that gold offers is really unparalleled in other stores of value. Gold has been an ounce of gold for 5,000 years. There are really no variations, no imitations. Central banks favor gold because of its density and rarity, but they don't hold diamonds or fine art because of their infinite variability. Bitcoin, on the other hand, is a string of code generated by software protocols and cryptographic algorithms. So if you're a venture capital techie in Northern California or Southern New York City, the immutability of the Bitcoin blockchain or software may be attractive, but I think to most quote unquote normal people who don't have a very high IQ in the technical side of things find Bitcoin a little ambiguous in terms of what it really means and, do you really own it and that type of thing. So I think the immutability of gold, in my opinion, is very, very different than what Bitcoin represents.
Well, and that really shifts gears to the next point then, right, which is volatility. Because, talking about high net worth individuals and someone looking to allocate capital to diversify a portfolio, right, to get a little bit of capital away from traditional stocks and bonds and help balance out return pattern of a portfolio, talking about gold versus Bitcoin, or that comparison, when you look at it through that lens, almost seems a little silly. Because when you start to dive into the volatility nature of cryptocurrencies in general, or specifically Bitcoin versus gold, I think the story becomes a bit more clear. So could you touch a little bit on the volatility of gold versus the volatility of Bitcoin and how that looks?
Sure. What's interesting in here is, having been a gold guy for a decade and a half, gold is an emotional asset and is traded that way, and therefore has earned a fairly volatile reputation. But on the other hand, compared to Bitcoin, it's fairly calm in terms of its trading patterns. Bitcoin has had a history of having one very large upward thrust in sort of a 12-month period, followed by an equally violent downward thrust, usually measuring, 1/2 or 3/4 of the upward movement. It is possible that we're about to break that trend because in recent months, Bitcoin seems to be doing nothing but going up. One of the interesting facts about why this may be the case is that about 4% of the Bitcoin addresses control 96% or so of the outstanding Bitcoins. Now, by addresses, I want to clarify, in the interest of full disclosure, Merrill Lynch on the stock side, in terms of street name, is one address for stocks. So Merrill Lynch shows up as the beneficial holder of a lot of stocks. Similarly, Coinbase is one address for owning Bitcoins, and they obviously own a lot of Bitcoins at that address. However, the fact remains that about 4% of these addresses, a fairly concentrated group of people and organizations, control 96% of the Bitcoins. This means that 96% of the Bitcoin addresses are flipping around just under 4% of the outstanding Bitcoins. So while no one knows for sure the exact math beneath those address components, I think it's fair to say that the limited amount of Bitcoins that are actually being traded by a very large group of people make them extremely volatile.
Well, and you talk a little bit about that, about the concentration or a limited number of addresses that control or are trading Bitcoin. Conversely, gold, on the other hand, is really broadly diversified. It's in the hands of individual investors. It's in the hands of bank balance sheets and portfolio managers and family offices and so forth. So I think there's something to that. The next page, I think, really, in my mind, when I look at this, I sort of step back because the volume or the sheer number of different cryptocurrencies out there, clearly Bitcoin being the current leader, is staggering. And walk us through this graph a little bit and talk a little bit about this as we continue to dive deeper into the concept of volatility and what that means in the cryptocurrency market.
Sure. So this graph, which has a lot of red on it, plots the 3-week decline in the top 50 leading cryptocurrencies by market cap in a 3-week period ending July 16th of this year. So we picked this period because this was the most volatile period to the downside in the cryptocurrency market this year. A couple of disclaimers here as well. These declines, which measured, as you can see, between 40 and 70% in this 3-week period, for virtually all of the top 50 cryptocurrencies, did follow a period of 6 to 9 months of very, very high advances, percentage advances in these currencies, sometimes on the order of 500-600%. Nonetheless, for any broad-based asset class to decline 40 to 70% in a 3-week period, I think disqualifies that asset class as a legitimate store of value. One other irony, by the way, is that this 3-week period, these declines were really motivated by the ongoing hard fork prospects for Bitcoin software, which was right around August 1st. And so a lot of cryptocurrencies were being sold by traders because no one really knew what the hard fork would mean for Bitcoin. Now that Bitcoin and Bitcoin Cash, which was the hard fork spinoff, sort of on a 1-for-10 type of basis, now that those two add up to more than what the value of Bitcoin was before, one of the reasons I believe cryptocurrencies are accelerating their upward movements is people are looking in the rearview mirror and saying, well, any hard fork's a good thing, and there is another hard fork in the software for Bitcoin on the horizon. So I don't know if I explained that well, but since it worked the first time, folks are thinking it's now an easy no-brainer the second time, which of course raises the question about whether that will be the case.
Well, and that shifts right into the whole notion of safety and trust, right? It's one thing for something to be volatile, right? Because volatility can be a good thing. As you just suggested, if you have volatility, there could be trading opportunities within that volatility. But it's a completely different thing when you start to think about it from a safety standpoint, or more importantly, a trust standpoint, particularly when you make reference to, a family office or an endowment or a university or a trust of some sort that its responsibility is really stewards of capital. Let's talk about the safety and trust and the differences in gold and Bitcoin and how someone should really view that.
Sure. So I like to always point out that gold has been the object of plunder and theft for many thousands of years, dating back to Incan kings and that type of thing. So it's not that gold hasn't always been an interesting thing to try to get your mitts on. And very recently there was a fairly high-profile theft in a apparently lightly guarded German museum where a very large sort of commemorative gold coin worth several $1 million was stolen by some thieves with a wheelbarrow, a rope, and a ladder. So, but I think outside that, there are certainly some bulletproof options for safekeeping of gold, like safes in homes and safe deposit boxes, and when you get up to the institutional level, sort of impenetrable bank vault networks. In contrast, Bitcoin, and by the way, there is a negative to that of cost, and that has been traditionally one of the knocks on gold is that you have to, that there's some storage costs involved in each of those options. Bitcoin, on the other hand, and I'm not an expert here, but I have certainly read a lot about the sort of internet connections involved with wallets and storage places, et cetera. And I still think there's a little bit of vulnerability in that internet connection between Bitcoin and cryptocurrency traders the ICOs, how they're actually flowed into accounts. And there's certainly been a lot of examples of disappearance of Bitcoins and outright theft, et cetera. So I think this just brings up the whole topic of the network of trust that the blockchain empowers. So to refer to Mr. Andreessen again, and he certainly knows this market as well as anybody, the real breakthrough for the blockchain and therefore Bitcoin is the fact that the blockchain establishes a distributed network of trust in which internet users can transfer digital property to one another in a manner that's deemed to be safe and secure, quite frankly, without knowing who the counterparty is. So historically, when you're conducting commerce or buying dinner at a restaurant and using a credit card or depositing your money for safekeeping, we've needed banks and credit card companies to establish that network of trust, sort of an oversight party. The whole appeal, or a lot of the appeal of the Bitcoin and blockchain to folks who don't want to pay high fees to banks and get hacked, is this decentralized ability to conduct commerce with people you don't know, without oversight, without paying fees, but with this network of trust. I would point out that, again, as we mentioned a bit earlier, while that network of trust may be sufficient for flipping around Bitcoins for a profit, I still don't believe that stewards of large amounts of accumulated wealth are comfortable that that network of trust is sufficient without some sort of oversight or centralization or authority figure to validate safekeeping and the like. So in my opinion, the blockchain will actually have the most productive and far-reaching applications in areas where there is this added centralization, or trust party.
Well, then it sounds like what it really comes down to then is scale, right? So, Bitcoin is very interesting. Obviously, as you mentioned earlier, who wouldn't like to have, a few thousand shares of Bitcoin for the last several years? But the reality is, from a portfolio construction standpoint, the scale, frankly, just isn't there yet, and it's to be determined if Bitcoin will ultimately be the winner of that. So let's talk a little bit about the scale and put some numbers behind that notion or that concept. What are we talking about? When we're talking about gold versus talking about Bitcoin, what does the scale look like? What is really the size of Bitcoin? What does that market represent today?
Mm-hmm. So the number of Bitcoin units theoretically permitted by the software currently in place is 21 million units. Currently, there are about 16.6 million Bitcoin units out there. There are a lot of descriptions of the complex math problems that Bitcoin miners are solving. I don't think it's explained clearly enough in a lot of these references that the math problems these miners are trying to solve are simply the last 10 minutes of transactions being added to the blockchain. So essentially what happens is every 10 minutes there's around 2,000 transactions that can be added to the blockchain block, and there are big computer farms that sit around and that are 100% of the time, 24/7, using enormous amounts of power to encrypt those 10 minutes of transactions to the blockchain. The miner who is successful in first accomplishing that task is rewarded with 12.5 Bitcoins every 10 minutes. So in other words, there's sort of a scrum every, around the clock, and whoever successfully incorporates the 10 minutes of transactions is rewarded with 12.5 Bitcoins. That's where that mining, complex math problems comes from. That rate of new Bitcoin issuance actually falls by 50% every 4 years. So in June of 2020, only 6.25 Bitcoins will be awarded each 10 minutes, and then in another 4 years it falls in half, etc. Theoretically, this is all supposed to stop in the future at 21 million Bitcoin units. As we've discussed, it remains to be seen if the miners who are currently competing for those 12.5 Bitcoins per 10 minutes will be interested in the project if those Bitcoins aren't there to be awarded. So if they're not, and Bitcoin is really capped at 21 million, it means that the transaction fees, which are currently running about $2 to $3 on top of this 12.5 Bitcoins issued every 10 minutes, which is really a tax on the whole system, those fees will have to increase markedly to motivate miners, to mine new Bitcoin. So there will certainly be the inclination somewhere out in the future that it would be a better idea to offer new Bitcoins to keep all that mining going. The scarcity value of Bitcoin, which I do admit is fairly intellectually attractive to someone who has spent time studying gold, does not apply, however, to all the other cryptocurrencies. And if you do a quick run through on some of the titles of some of the cryptos, I don't think I could repeat some of the names here, but we've gotten into the truly ridiculous in terms of different cryptos and ICOs, et cetera. We mentioned how large the number of cryptos is at this point, and there's no limit on issuance of those in the future. So while Bitcoin represents, there's no question that cryptocurrencies are here to stay. There's no question that cryptocurrencies are an asset class, and there's no question that to many portfolios, both Bitcoin and its crypto brethren, represent an extremely productive speculation. But the total market cap of Bitcoin itself, which I think is sort of the highest quality option, is today just under 100 billion. And so it really doesn't provide a huge opportunity for institutions or larger, family offices or endowments or pension funds to get involved. And gold, with it currently the above ground stock measuring about 7.8 trillion, does offer that depth and liquidity. And as you mentioned, there's a lot of gold around in a lot of different forms, and the above ground stock is relatively stable. We only mine about 1.5% of that 7.8 trillion each year. So the above ground stock is very stable and dependable. There is, I guess, a pushback from Bitcoin enthusiasts would be a lot of that 7.8 trillion is in central bank vaults and in the form of jewelry, and that is true. But even in outside what central banks own and what is commonly assumed to be in the form of jewelry, that leaves about 3 trillion in the above ground tradable stock of gold versus about 100 billion for Bitcoin.
Well, and I think that really brings us to one of the final points we want to make, which is we're not here to say Bitcoin's good or bad, or we're here to say gold's better than Bitcoin, but what we are here to say is that they're different, right? I mean, I think so often we're hearing how Bitcoin is the new gold. The reality is they're very different. I mean, if you just think about it from a time standpoint, thousands of years versus less than 10. If you think about it as far as who owns it, where it's created, Bitcoin is primarily the focus of Silicon Valley, where central banks trade, invest, and own gold for decades for for thousands of different types of clients, whether it's institutional clients or individual clients. From a volatility standpoint, Bitcoin is very concentrated in its ownership, where gold is widely held. From a safety and trust standpoint, gold is strong legacy of trust and oversight. The methods, frankly, are still being built and they're ever evolving in the Bitcoin space. And then your last point, the scale point, close to 8 trillion versus just shy of 100 billion. So what I want people to walk away with today is that Bitcoin is not gold and gold is not Bitcoin. They are very different. Gold is a proven diversifier in a portfolio, and Bitcoin is remains to be seen. If you think about it, even a little more simplistically, think about gold and its effective long-term investment merits and a proven store of value, and then look at what we've seen at Bitcoin from a speculation standpoint. It really can't replicate gold as a store of value or as an investment. And I think, you've said this before, and I would agree with this, in the current environment, gold should be viewed as really a mandatory allocation today in a well-diversified portfolio. And I think that brings us to really one of the final points, which is at Sprott, having 3 decades of experience in this space, we offer multiple solutions within the gold trade, from the physical gold trust that we talked about earlier to the factor-based ETFs that we made reference to, and even in the long, short, and private and public vehicles that we offer to private lending, private credit, to equities and so forth. So we have many solutions in this space for those that are truly looking to use gold as a diversifier in their portfolio. Having said that, we can't ignore the reality that Bitcoin is here to stay, or cryptocurrencies are here to stay. And I think a digital world is something that people are clearly interested in and moving towards. And to that point, we have partnered with a firm as well to really bring gold into that modern world. Sprott has partnered with a company called Tradewinds, which markets and has moved gold towards digitizing it and modernizing it through the IEX exchange technology. In fact, Tradewinds is a technology company developing platform solutions for physical gold. And you mentioned it earlier, Trey, and I think this is an interesting point also, is that people talk about Bitcoin and cryptocurrencies, but I think what people really should be talking about is blockchain, right? Blockchain is really the market-changing, environment-changing technology. And through blockchain, this allows Tradewinds, our partner, to actually digitize gold through the creation of digital gold, which has a ticker of DAU, and has the ability to do QSIP registration. So we are, like many companies, continuing to move into the modern world of investing. We're working on models to digitize gold as well, and allowing that to be very competitive, whether you're storing it in a bank, you're storing it in a vault, you're storing it with a third party, or you're storing it through the Canadian Crown Mint like we do through the Sprott Physical Gold Trust. There are multiple ways you can allocate to this space. And through our partnership with Tradewind, that ecosystem is ever expanding through a broad set of industry-leading participants like ourselves and IEX. And we've secured multiple key market participants in vaulting, operations, and market making and distribution. So we, like other markets out there, are continuing to move forward in the gold market, believing it is what it has been for thousands of years, a wonderful store of value, but also recognizing there's other ways to look at it, the way gold has been looked at, and now the way Bitcoin or cryptocurrencies are being viewed today. So
one thing I would add to the Tradewind partnership is, in my opinion, this is a good example of what we were talking about a little earlier, in that introduction of a trust or authority figure allows applications for the blockchain that would not otherwise have been the case. So in this case, Tradewind allows various parties to trade instantly over the blockchain through a market network that is posted with bids and offers, physical gold that is held at the Canadian Mint. And it's that oversight that the Canadian Mint brings to the fore, which really separates Tradewind from some of these other blockchain applications where the counterparty remains anonymous.
Yeah, and that's actually an excellent point. And stay tuned and please reach out to us if you have interest in learning more about our relationship with Tradewinds and digital gold as that gets closer to its official rollout. Some questions have been actually coming in at a pretty nice clip actually over the last half hour or so, but we also got a few questions that came in at time of registration. So I think we've got another 10 minutes or so for our listeners to really go through a couple of the questions that I've been looking at here during the presentation that I think may make some sense and represent probably the greatest interest as far as the volume of questions that have come in. The one that it seems we get every time is, what percent of a portfolio would you suggest I allocate to gold as a long-term investment? Can you address that a bit for the listeners?
Sure. So it's gold's a very personal decision. I always like to point out that gold is not an investment that you sell. It's an investment that investors or trustees or a group of people have decided that it is appropriate for reasons that sometimes take many years to parse through. But when that decision to have a gold allocation has been made, a lot of empirical work has demonstrated that a gold allocation of 1 to 2% is really, holds up to scrutiny in any sort of investment framework. And then in accounts that are, perhaps a little bit more aggressive, or in times like I would say the current times where there is a lot of uncertainty both on the geopolitical or financial front, a higher allocation up to say 5% might make a lot of sense. So there's a lot of math that suggests that the presence of gold in any type of portfolio over time in up and down markets will increase return with the same amount of volatility and risk, or provide higher returns with the same amount of volatility and risk.
So clearly the allocation, simply put, should be greater than zero.
Absolutely.
So another question that came in, which I haven't seen this one come in or brought up as recent, but this is something that clearly people talk about over time, which is how important is China and India to the long-term demand on gold?
I think the quick answer is very important. China and India represent a little over 50% of total physical demand each and every year. Interestingly, that number has been similar for many, many years. So physical demand out of China and India is hugely important, but it's also hugely stable. Even in India, where the government seems to have been a bit on a crusade to encourage Indian citizens to buy less physical gold and all sorts of other alternatives like paper gold and trusts and certificates that the government has urged banks to offer. Of course, anytime a government tries to convince its citizenry to deviate from long-held preferences, the response is usually the exact opposite of what the government is trying to encourage. So Indian demand has remained very stable through this period of the past 2 or 3 years when there's been a lot of governmental interference. Moving forward, I expect that to remain the case. China has really taken over from the LBMA, the London Bullion Market Association. The Shanghai Exchange is now the leading physical market for gold in the world and really sets the tone. Importantly, though, I think what really sets the gold price are not Indian or Chinese physical gold traders, because they're fairly price sensitive and don't have a tendency to chase the gold price either up or down. But I think the gold price is more commonly set in the Western physical demand part of the quotient. So I think it's when Western demand is high for investment in gold, and faith in monetary and fiat currencies are challenged a bit. That's usually the swing factor that leads to sharp increases in the gold price. So China and India are important and stable, but I think the variable that really determines the gold price over the short and intermediate term is more connected to Western investment demand.
Okay, great, thank you. And this is one that I think we address, but it's probably worth repeating if a question is being asked of it, which is, who are the 3 largest internet retailers accepting Bitcoin for payment? And I was just kind of flipping through here. If you go back to page 10, we do make reference to this, and it's really, if you look at it, it's Overstock.com, Expedia, and PayPal currently accept Bitcoin as 3 of the largest retailers out there. What I think is interesting from a tech-savvy standpoint, Amazon, Apple, and Walmart, not sure Walmart is necessarily tech-savvy, but certainly Amazon and Apple are, they do not currently accept Bitcoin. So Overstock, Expedia, and PayPal currently do. And that's only 3 of the 500 largest internet retailers out there, which you made reference to earlier. So I think that's interesting, that as though people talk about it from a currency standpoint or a means of payment, only a few of the largest retailers out there are currently accepting it as means of payment. And I think your example about selling a shovel today and then wondering if you're going to get paid for it for the next day and a half has got people sort of thinking before they accept it as a means of payment. Here's one that I think is a bit heady for me, so I'm going to certainly turn this one back over to you, which is, you talked about limited supply earlier with Bitcoin. The question is Bitcoin truly limited? What happens if the proverbial they decide to increase the hard cap on supply?
So as we mentioned earlier, 75% of the hashing power, which is the term used to describe sort of the meat of computer systems that are recording these transactions on the blockchain, 75% of the hashing power is now concentrated in 4 organizations or firms, all of which are located in China. In fact, 81% of the hashing power of the blockchain emanates from China. There are no legitimate hashing operations in the United States. The other ones are spread out over places like Iceland, etc. The reason for this concentration is not as much to do with political affiliations or that type of thing. It really emanates almost solely from the availability of cheap power, because power is such an important quotient in processing these transactions on the blockchain. So China originally was an area where mining networks and hashing operations were able to compete effectively because power is very cheap in China. Interestingly, the internet access in China is very spotty, and in the United States it's sort of the reverse. We have fairly free internet access but higher power costs. So that actually led to, by the way, some of the differences on how miners wanted to see the software fork go. And in China, they favor anything that has to do with power and less on the internet access side. But it is interesting that these 4 firms control 75% of the trades, and it's basically a cartel in China.
Well, I think you said something earlier, and I think it's probably worth repeating. You had mentioned the limited supply of gold versus the limited supply of Bitcoin. And what was that great quote? I think it's worth repeating that quote again because it's a good way for people to put it in context.
Yeah. So the limited supply of gold versus Bitcoin. The phrase is that Bitcoin is limited by the laws of math. In the software programming on which it's based, and the limited supply of gold is based on the laws of nature, because gold only appears in the Earth's crust at 3 parts per billion and is fairly difficult to extract.
Yeah, so I guess it's sort of a to be determined what would actually happen to that price if they in fact increase supply at some point down the road. So to be determined on that. This is one that it's sort of similar to or along the same lines as the percent that you would recommend in allocating gold to a portfolio. What factors determine the gold price? That's another question that just came in.
So I think that over the short and the intermediate term, the impact of geopolitical events is fairly overrated in determining the gold price and the prospects for the gold price in the future. The real determinant of intermediate and long-term, gold price movements is really general confidence in the monetary status of the world, general confidence in central bank stewards. Jim Grant always likes to say the gold price is the reciprocal of faith in central banking. So if we're in a period where investors as a whole are comfortable with the dollar, comfortable with central bank stewards, comfortable with the debt levels around the world, especially domestically, but around the world, the gold price, and I obviously have to mention when stocks are hitting new highs every day, the common conclusion would be who needs gold. When faith in any of those factors that I mentioned is challenged, much less all of them at the same time, there is an increased desire among investors, generally at the margin, to get a little bit of money safely outside the financial system. It could be because stocks are perceived to be overvalued. It could be because faith in the U.S. dollar and the ability to hold its value is challenged. It could be the repressive or negative interest rate policies of central banks. But generally, those types of concerns in investors' minds will lead to an increased demand for gold over the intermediate and long term. This is a little bit controversial, but I would say that the gold price itself, there's really no infallible equation or relationship that determines what's the appropriate price for gold. It's always the relative attractiveness for that ability to get a little money safely outside the financial system, and therefore, whether the gold's price is $1,500 or $1,400 or $1,200 or, for that matter, $2,500, it's not really the price itself as much as these factors related to confidence in the monetary and central bank backdrop of the world. So I would say that, above all else, the gold price is determined, by general investor faith in the financial system.
Okay, great. And we're coming up close to an hour here, but before we wrap it up, I do want to get one more question in here, and also remind all the listeners that we are receiving more questions, and we are going to aim to get back to everybody either by an email response and/or a phone call in the coming days. Some of these questions, frankly, we need to do a bit of research on. They're pretty big deep dives, but we do want to get back to everybody on all the questions. So as they continue to come in, we'll be very responsive to that over the coming days. But we'll finish with one that I think may be of interest to all of our listeners as well, which is what's going on from a pricing standpoint, right? So the question is the price of gold being suppressed by the capital moving to cryptocurrencies? What's your view on that?
We talked about this a little bit earlier. My personal view is that the price of Bitcoin is being controlled or determined by a group of well-heeled speculators, both here and around the globe. It is interesting that Bitcoin's ascent in 2017 followed very closely the decision by the Japanese government to recognize Bitcoin as legal tender. I have noticed that there is a fairly outsized impact on current Bitcoin pricing by decisions that are made from other governments, whether it's India and the decisions they made to tax Bitcoin like gold, or when the SEC made its first attempt to sort of regulate ICOs when the SEC determined that they would look at ICOs as securities. So a lot of the things that affect the Bitcoin price are developments in governmental decisions around the globe, which certainly cannot be foreseen. So there's a bit of randomness, I guess, there to enthusiasm for Bitcoin. There's no question that there are some traders of Bitcoin who, regulate their interest in the cryptos based on developments, central banks, whether the Fed is going to raise rates or not. There's certainly a little bit of an impact there. But because the gold market is as large as it is, and because folks operating in the gold market operate for so many different reasons on so many different levels, I really don't think one can assume that the gold price being relatively stable, which is I think where this question comes from, is why isn't gold doing better? Mm-hmm. And I think the answer is gold's doing what it has for thousands of years. It's providing that sort of stable store of value amidst all the excitement and confusion of modern markets and the amount of money that's chasing Bitcoin, et cetera. I really don't think that has much of an impact on gold at all. But we'll see where this all leads in the next several years with respect to Bitcoin and how it's perceived as the eventual winner in the cryptocurrency race.
Well, that's great, Trey. I mean, we could literally spend another hour just on the Q&A session of this, because they continue to come in, and there's a couple very specific ones as it relates to trade wins as well. We will do our best to get back to everybody in the coming days on all these questions. Thank you all for participating in the webinar today. We appreciate your interest in our views, and please reach out to us at Sprott.com to learn more about how we can allocate capital effectively for you and your clients in the gold and gold equity space. With that, we'll say goodbye and hope to meet and speak with many of you soon. Thank you.